Hello, my name is Seth David, and this is another webcast brought to you by Nerd Enterprises Incorporated. And I'd like to invite you to visit our website at www.nerdenterprises.com. You'll see a link there to join our online community. I invite you to do so. You can network with other fellow nerds and fans of Nerd Enterprises and friends and clients and vendors of Nerd Enterprises. I'm inviting everyone to join our own little Facebook, but it's just for nerds. So if you're a nerd and you want to be around other nerds, join my online community. Just go to nerdenterprises.com and you'll see the blue underlined text, which is a hyperlink on the web, that says join my online community, and you'll be a part of it. You'll be one of us. We'll take you in, and if you're not a nerd, we'll make you a nerd. On to business. Today's webcast is a long-awaited request from the QuickBooks blog about how to do accounting for leased or rented inventory. The gentleman has a car dealership, or not a dealership, but he rents cars. He has a car rental place, and he wants to know how to handle the inventory, because we have to track inventory that's in stock versus inventory that's out of stock. And he wants to know, can we do this in QuickBooks? The answer is, of course you can. You just have to think a little out of the box. And always, you got to think in terms of, how do I make QuickBooks mirror what's going on in real life? So with that, I'm going to bring you into a sharing screen. I'm going to show you my QuickBooks file. And that's all I'm going to show you. The rest is private. I'm going to share my computer screen here. I'm going to enlarge this. Don't be alarmed. I'm going to bring this up into a full screen view. Whee! And you should be seeing my QuickBooks file. Now here's the key. Basically what happens is this. If you understand how QuickBooks and inventory works, we have our item list, and then we have our balance sheet inventory accounts. And the items in the item list are going to be mapped to the appropriate balance sheet account, especially when we're dealing with inventory. When you're dealing with a service item, it's generally going to be mapped to a P&L account, usually an income account. But when we're dealing with inventory items are actually mapped in multiple places, because when we sell inventory, there's a few things that happen. The first thing is I reduce inventory by a quantity of however many I've sold. I've also now incurred cost of goods sold. I also now have income. I have a sale. And now I also have a receivable. Somebody's got to pay. Somebody's always got to pay. So I have four components when I sell inventory. There's the sale, there's the receivable, there's the reduction in inventory, and then there's the cost of that sale, which is where when I reduce the inventory, basically it's the cost of the item, what I paid for it, transfers from inventory to cost of goods sold. So now it's like an expense on the books. So I have to map my items accordingly, which means that if I want to account for leased inventory out of stock versus what's in stock, then essentially what I have to do is I have to create two sections in the item list and corresponding two sections on my balance sheet. Let me run a balance sheet real quick. And I don't have time in a webcast to show you the entire setup. And I have nothing booked yet on this sample company file, so you're not going to see it here yet. Let's go to the chart of accounts instead, and I'll show you that I have inventory in stock and inventory leased out. So those are the two accounts. They have to be mirrored. So anytime I lease out or rent out some inventory, if I rent a car or maybe I'm renting equipment, what I have to do is I have to book an invoice that essentially sells it for nothing, because I'm going to have two invoices to book. One is to record the contract, whatever I'm renting it for, some monthly fee, or maybe I'm going to book it for the whole contract amount right up front. It depends how I want to do my accounting, and you should speak to your CPA about that. Generally speaking, if you have a monthly contract, then you should post an invoice each month and recognize the income in the appropriate month. But it might be, for whatever reason, that in your particular industry, it's more standard to book an entire contract up front. That's between you and your CPA. If you want to speak about your own situation directly to me, feel free to email me. My email is seth@nerdenterprises.com. But now on to business. So we have two invoices when I lease something out. Let me see what I've set up here for customers. So I have a sample customer. I have lease customer and customer 2. Perfect. So let's invoice lease customer. And essentially what I'm going to do, and now QuickBooks 2010 is Always trying to sell me stuff. So what I'm going to do is I'm going to book 2 invoices. One is for the lease contract. I don't care about that for the purposes of this tutorial. That's easy. You set up an invoice. You have an item for the lease contract. It goes to an income account. That's done. The hard part is then the second invoice that you have to book, because you want to reflect 2 things. One, the fact that the inventory is out of stock. 2, which customer has it. So I book an invoice to that customer. The invoice is going to be a $0 invoice. So I have lease customer. Now, of course, in a real situation, you would have that customer's contact information and the bill to and the ship to. And over here, what I'm going to do is put in the quantity, because I want to transfer one item. Let's say I'm leasing out a car. I want to transfer one item out of my in-stock inventory and into my out-of-stock inventory. So this is the critical part, and you have to understand so clearly how the invoice works. Remember that a quantity of +1 on the invoice means a reduction of 1 in inventory. So the quantity, the line item where I put a quantity of +1 is going to apply to the in stock, because it's no longer in stock. So I'm going to choose item 1 here. Now I'm being warned that there's nothing in stock. And let's say the cost of that inventory is $5,000. Inexpensive car, right? So there I put the 5,000. Here I put a quantity of -1, and it goes into inventory leased out for item 1, 5,000. So notice my invoice nets out to 0. I've got +5,000 and -5,000. I'm not making a profit on this. I'm just transferring the inventory at cost from one inventory category to another. And when I click Save and Close, we'll go over to our balance sheet. First, QuickBooks is going to try and sell me on credit card services. We'll go over to the balance sheet. I'll click Yes to refresh the report, and now see what happens. I have inventory in stock for 5,000, inventory leased down for 5,000. Now the assumption would be that first I have to have inventory in stock in the first place to transfer it out. That's why it's showing up as negative. So I skipped a step, because at some point when I started my business, I went out and bought the car. So let's do that. Let's record that. I go to my vendors and I enter a bill. It's really simple. I want to be in my items tab, and I've got my wholesaler Inc. set up. So I bought this car for 5,000, and at that point it was inventory in stock. I'm buying the car, so I'm putting it in stock, and now there is an actual cost to it. So when I bring it in there, and let's say I got 2 of these. This way everything will show up nicely on the balance sheet. So let's say I bought 2 cars, and now I've rented one out. I've got another one sitting on the lot waiting to be rented out. So this is perfect. So, and let me just backdate this to, let's say we bought it last month on November 2nd. I click OK. Oh, it's yelling at me. The transaction's not in balance. Got to make sure the transaction's in balance. It's all about balance in accounting. So now we've got some interesting stuff going on. I've got 1 car in stock for 5,000, 1 car leased out for 5,000. I've got accounts payable now of 10,000 because I got to pay somebody for the cars. I buy the cars from the wholesaler and then I rent them out. So this is how you do it. Now, what I've got on the books, if I go to my customer center, is I've got lease customer, and here's the invoice for the car. Notice it's 0. Now again, I would invoice the customer. Let's just do it real quick. And we're going to lease them out. So here's the service, the lease. And let's say we're leasing it out for, I don't know, $300 a month. Let's just say. Probably be more than that for a month. And once again, they're trying to sell me something. So now I've got something that makes sense. Here's my lease contract for the $300. And here's a $0 invoice, which, because I know the system that we're using, I know that a $0 invoice means this is for the inventory that's leased out. Now, of course, what happens when the customer brings the car back? Well, I've got the same thing. I book another invoice. I can do it one of 2 ways, actually. One way is I can just delete this invoice. I don't recommend that because you want to kind of have the history of what happened, that we leased the car out to this customer on December 2nd, then maybe a month later on January 2nd, the customer brings it back. I want to book another invoice. I don't want that. I book another invoice to my lease customer. Now I'm going to bring it back in, so I do -1 actually, and we're going to bring it back into inventory in stock, 5,000. I'm going to do +1, and I can copy this down for a minute to get to the right section in my item list, because your item list is going to be a lot longer than this. I just have 1 item set up here. You're going to have presumably many. So the +1 goes here. Save and close. Again, they're trying to sell me. Let's close that and go to our balance sheet. Click Yes. And now I've got both cars in stock, $10,000, and I still haven't paid for them, so I have accounts payable of $10. And here's my net income. Here's the $300 from the sale that I made, which if I run a P&L real quick, we'll see. That is how you handle accounting for leased equipment or car or rented equipment or car rentals. That's how you do it. That's how you do the ins and outs. I don't have time to get into the setup, but I am available for a direct consult. Just email me at seth@nerdenterprises.com, and I'll be more than happy to schedule a private session with you in which I can show you how to actually go through the whole process doing all the setup. So I hope you enjoyed this webcast. I hope you found it informative. Check out our interactive webcast. We have one on the accountant's copy on our QuickBooks blog. Check that out. That's where you'll find this webcast too, very likely. And I look forward to seeing you on the web.